Hello, you are welcome once again to OA Accountancy Stuff. In today's video, we'll be looking at adjustments of final accounts of a sole proprietorship. But if you haven't subscribed to this channel, I will entreat you to kindly subscribe, like, comment, and share for the benefit of others. As we all know, final accounts are prepared from the trial balance, and if you've realized, whenever you are given questions to prepare final accounts, there are some information right after the trial balance. This information is what's referred to as additional information, footnote, or further information. So this additional information, when are not treated properly, will foil your final account from agreeing or balancing. So in today's video, we'll be looking at how some items in the additional information are treated in the final accounts of a sole proprietorship. So we will first begin with prepayments and accruals of expenses and revenues. But before we proceed, it is advisable that whenever you are preparing final accounts of a sole proprietorship, you always go by this general rule. And the rule says that whenever you are preparing final accounts, items in the trial balance should be treated once, whilst the items in the additional information should be treated twice. So now back to our prepayments and accruals of expenses and revenues. So let's first tackle expenses. Under expenses, we have prepaid expenses and accrued expenses. So let's begin with prepaid expenses. Expenses is said to be prepaid when the expenses paid is more than the expenses incurred. One may ask that what's the difference between expenses incurred and expenses paid? Expenses incurred is the expenses one is supposed to pay for an accounting period. Thus, expenses incurred is the expenses that relate to the accounting period in question. And the expenses paid, on the other hand, is the actual expenses one paid for the accounting period. Always, the expenses paid is the one on the trial balance. So this means that whenever you see expenses on the trial balance, whether it be insurance, rent, electricity, or whatever, that expenses on the trial balance is the expenses paid, not the expenses incurred. So it is the additional information that will guide you on how to ascertain the expenses incurred. But as we said earlier on, always the expenses on the trial balance are the expenses paid, not the expenses incurred. Okay, for example, assuming you rented a house for your business, and the rent agreement is that you were supposed to pay 1,000 Ghana cedis per annum for the rent. But because you had the intention that you will stay in that room for more than one accounting period, you decided to pay 1,200 Ghanaian cedis for the rent with the mindset that in the next coming year, you only top up with 800 cedis. So in this case, the one that you are supposed to pay, which is the 1,000 cedis, is the rent expenses incurred. And the rent expenses paid in this case is the 1,200 that you actually paid. So let's take this to be our trial balance. This being our debit side and our credit side. So we have rent here. So on the trial balance, we have rent of 1,200 cedis. And the additional information, as we said earlier on, will guide us to ascertain the expenses incurred. So if the additional information is silent about an expenses on the trial balance, then it means the expenses on the trial balance, which represents the expenses paid, is the same as the expenses incurred. That's why the additional information is silent about the expenses. So let's assume additional information one says rent expenses, rent prepaid is 200 cedis. So as we said, the expenses on the trial balance represents the paid. So this additional information means that included in this 1,200 cedis is 200 cedis paid in advance. So this means that this amount does not represent, or this amount do not relate to this accounting period. So we need to take out this amount from the amount paid to get our actual expenses incurred. So to get the actual expenses incurred, or to get the rent expenses incurred in this accounting period, we will take out the 200 cedis from the 1,200 cedis to get our rent expenses incurred. And as we said earlier on, items in the additional information should be treated twice, whilst items in the trial balance should be treated once. So between this 1,200 and these 200 cedis, which one should be treated twice? Obviously, it is the 200 cedis, because The 200 cedis, which is the prepaid rent, is the one in the additional information. The 1,200 cedis is the one on the trial balance, and that's the rent expenses paid. So in treating this, we will go to our statement of profit or loss account, because we all know that indirect expenses can be found on the P&L section of the trading and profit or loss account. So let's take this to be our statement of profit or loss account. It's a 3-column. Let's assume we have our gross profit here of, let's say, 20,000. And you will say less indirect expenses, if only we do not have any other income. Then here we can say, let's say, bad debts. We all know that expenses are on the second column of the statement of profit or loss account only if that expenses do not have any adjustments. So this bad debt will be sent straight to the middle column if the bad debts do not have any adjustments. So you will say bad debt of, let's say, 100. Then you bring our rent. So we will first begin with the rent on the trial balance, which is the rent expenses paid. So we will bring our 1,200. Because this rent is subject to adjustments, it will be on the first column. Then we adjust it and we will send the final amount to the middle or the second column. So the paid is 1,200. Then because we said the prepaid rent needs to be subtracted from the rent expenses paid, then we will bring our prepaid rent here of 200 cedis. We all know that bracket means we are subtracting from the above figure. So we will take it out to get 1,000 cedis. So this 1,000 cedis is the rent expenses incurred. And we need the rent expenses incurred, but not the rent expenses paid, because adjustments of prepayments and accruals of expenses and revenues are made in compliance with the matching and accrual concepts. And the matching concept says that in preparing your final accounts, the expenses incurred should be matched against the revenue earned. So because this matching concept is our guide, then it means the matching concept says the expenses incurred, not the expenses paid. So that's why we've accounted for, or that's why we've calculated for the rent expenses incurred but not the paid. Okay, so this is the first treatment of prepaid expenses. And the first treatment is that the prepaid expenses, which we already said are always in the additional information, will be subtracted from the expenses paid in the statement of profit or loss account to get your expenses incurred. And this expenses incurred is the one that will be added to other expenses. So this expenses here represents the rent expenses incurred. So we will add this rent expenses incurred to other expenses, and at the end of the day, we will sum up to get our total expenses, and that total expenses is the one that will be subtracted from the gross profit to get our net profit or loss. Items in the additional information need to be treated twice, but items in the trial balance need to be treated once. So this rent expenses paid, which is the one on the trial balance, has been treated once, and thus it has been sent here, or it has been treated here. So we are done with the rent expenses paid. So it's left with the second treatment of the prepaid expenses or the prepaid rent. So the second treatment of the prepaid rent or the prepaid expenses is that because we've paid for an expenses that have not incurred, or because we've paid for a facility which we've not used it yet, then it means that value of prepaid expenses has become an asset. So in this case, this asset is our current asset. So the second treatment of prepaid expenses is that prepaid expenses will be treated as current assets in the statement of financial position. So the first treatment is, you will say, it will be subtracted from expenses paid to get expenses incurred. in a profit or loss account. The first treatment of prepaid expenses is that prepaid expenses will be subtracted from expenses paid to get the expenses incurred in the profit or loss account. And the second treatment is that prepaid expenses will be added, or it will be treated as current assets. So it will be added to current assets. In the balance sheet or statement of financial position. That's the second treatment of prepaid expenses. So now let's move on to accrued expenses. But prepaid expenses can also be called expenses paid in advance. And accrued expenses can also be called expenses owings, expenses in arrears, expenses due, or expenses outstanding. So expenses accrued or expenses outstanding, or whatever you call it, is said to happen when the expenses incurred is more than the expenses paid. So now we know the expenses incurred and the expenses paid. So let's take the same rent for example. Assuming you are supposed to pay 1,000 cedis for your rent per annum, but you decided to pay 900 cedis for the rent. So in this case, the 1,000 cedis that you were supposed to pay is the rent expenses incurred, but the 900 cedis that you actually paid is the rent expenses paid. So since the rent expenses incurred, which is the 1,000, is more than the rent expenses paid, which is the 900 cedis, then we can say there is an expenses owings or expenses in arrears. So let's take this to be our trial balance. On the trial balance, we have rent paid of 900 cedis. And in the additional information, rent of 100 cedis is in arrears. So the additional information is saying that rent expenses of 100 cedis remains unpaid or is in arrears. So how can we ascertain the rent expenses incurred? Because we now have the rent expenses paid, which is the one on the trial balance, and the additional information is saying that 100 cedis of rent expenses remains unpaid. So the first treatment of expenses owings is that the rent expenses which remains unpaid will first be added to the one paid in the statement of profit or loss account to get your expenses incurred. So to get your rent expenses incurred, you add this 100 cedis to the 900 cedis in the statement of profit or loss account. So let's go back to our statement of profit or loss account. So under the rent section, you first bring the one on the trial balance, which is the rent expenses paid. So we will bring 900 cedis here. And the one in the additional information will be added. So we can say unpaid rent or rent owings. Rent owing 100 cedis. So when you add 100 cedis to 900 cedis, you will get your 1,000 cedis. So this 1,000 cedis is the rent expenses incurred. And this is the one that the matching concept is saying should be matched against our revenue to get our profit or loss. So this is the one that will be added to other expenses to get your total expenses. And at the end of the day, the total expenses will be subtracted from the gross profit or loss to get your net profit or loss. Okay, so the first treatment of expenses owings is that the expenses owings will be added to expenses paid in the profit or loss account to get your expenses incurred. That's the first treatment. And the second treatment is that because we've incurred expenses but we've decided not to pay, then that value of unpaid expenses is our liability. But in this case, the liability is a current liability. So the second treatment of unpaid expenses or expenses in arrears or expenses outstanding is that it will be added to current liability in the statement of financial position. or the balance sheet. So we will say expenses owings or expenses outstanding or expenses due or expenses in arrears. Expenses owings will first be added to expenses paid to get expenses incurred in the profit or loss account. That's the first treatment. And the second treatment is that the expenses owings will be added to current liability in the balance sheet or statement of financial position. So as you can see, the second treatment of prepaid expenses is that your prepaid expenses will be treated or it will be added to current assets, whilst the expenses owings will be added to current liabilities. So we can just say that prepaid expenses is the opposite of expenses owings or expenses outstanding. So now let's move on to revenues. Under revenues too, we have prepaid revenues and revenues outstanding or revenues owings. So you will first begin with prepaid revenues. Revenue is said to be prepaid when the revenue received is more than the revenue earned. So here too, one may ask that, what's the difference between revenue earned and revenue received? The revenue earned is the revenue one is supposed to receive for an accounting period. Thus, it is the revenue that relates to the accounting period in question, whilst the revenue received is the actual revenue one received. And here too, the revenue received are always the one on the trial balance. So whenever you see any revenue on the trial balance, then it means that revenue is the revenue received, but not the revenue earned. So it is the additional information that will guide you to ascertain the revenue earned. But if the additional information is silent about any revenue on the trial balance, then it means the revenue on the trial balance, which is the revenue received, is the same as the revenue earned. So let's take this for instance. Assuming you made an investment of 10,000 Ghanaian cedis and you were supposed to receive 10% of the investment as your interest per annum. But at the end of the accounting period, you received 1,500 cedis as your income from investments. So in this case, the one that you were supposed to receive is 10% of the 10,000 cedis. So 10% of 10,000 cedis will give you 1,000 cedis. So that's the investment income that you were supposed to receive. But here is the case that you received 1,500. So the additional 500 cedis that you received is called unearned revenue. So let's take this to be our trial balance. And in the additional information, the first one says that included in the investment income is 500 cedis paid in advance. On the trial balance, you have investment income of 1,500 cedis. But in the additional information, it's telling you that included in the investment income above is 500 cedis paid in advance. So this means that 500 cedis out of the 1,500 cedis is unearned revenue. You only receive that 500 cedis by mistake. So how will you be able to ascertain your revenue earned? Because we've already said that always the revenue on the trial balance are the revenue received, not the revenue earned. So it is the additional information that will guide you to ascertain your revenue earned. So here, to get your revenue earned, you need to take out the unearned revenue or the prepaid revenue from the revenue received. So in our statement of profit or loss account, we all know that revenues are treated as other income and other incomes are added to gross profits. So in the statement of profit or loss account, these are 3 columns. And we have our gross profits of, let's say, 20,000. So you write other income. So you first bring the revenue on the trial balance because that's the revenue received. So you bring investment income. Investment income of 1,500. Then you bring the one in the additional information. But since the one in the additional information is unearned revenue or is paid in advance, then it means it needs to be subtracted or it needs to be taken out from the one received to get the one earned. So you will bring unearned revenue or prepaid revenue. Prepaid investment income of 500 cedis. So we take it out to get 1,000 cedis, which is the investment income earned. So this 1,000 cedis is the one that relates to the accounting period in question. And this is the one that will be added to the gross profit. So the first treatment of prepaid revenue is that the prepaid revenue will be subtracted from the revenue received to get your revenue earned. And the revenue earned is the one that will be added to the gross profit. And since we said that items in the additional information need to be treated twice, then the second treatment of prepaid revenue is that because we've not earned the revenue but we've received that revenue, then that revenue is our liability. And this liability is a current liability. So the second treatment of prepaid revenue is that it is our current liability and it will be added to current liability in the balance sheet or statement of financial position. Okay, so now let's move on to the revenue owings or revenue in arrears. Revenue owings or revenue due is said to happen when the revenue earned is more than the revenue received. We now know the revenue received and revenue earned. So with the same investment, for instance, assuming you are supposed to take 1,000 cedis as your investment income per annum, but you actually received 800 cedis. So in this case, the 1,000 cedis is your revenue earned, but the 800 cedis that you received is the revenue received. And we all know that in the trial balance, it is the 800 cedis which represents the revenue received that will be sent or that will be found on the trial balance. So let's take this to be our trial balance. That we have revenue or prepaid revenue. And revenue owings. So on the trial balance, we have investment income. of 800 cedis. And in the additional information, one says that 200 cedis and the additional information is telling us that 200 cedis of the investment income remains unpaid. So in this case, it means the investment income earned is not the 800 cedis on the trial balance. So to get your investment income earned, you need to add the 200 cedis which remains unpaid to the one you received. So in the statement of profit or loss account, assuming these are gross profits, we have gross profit of 20,000. Then we all know that investment income will be added to gross profit as other income. So we will say add other income. Then we will bring investment income on the trial balance. That's 800 cedis. Then you will bring the 200 cedis which remains unpaid. So unpaid investment income or investment income owings. Of 200 cedis. So it will be added to the one received to get the investment income earned. So that will give you 1,000 cedis. So it is this 1,000 cedis that will be added to the gross profit. So the first treatment of revenue owings is that the revenue owings will be added to the revenue received in the statement of profit or loss account to get the revenue earned. And the second treatment of revenue owings is that because we've earned that revenue but we are yet to receive the revenue, then that revenue is our asset. And this asset is our current asset. So revenue owings will be treated, or the value of revenue owings will be added to current assets in the statement of financial position or balance sheet. So the second treatment of revenue owings is the revenue owings will be added to current assets in the statement of financial position. So the first treatment is that the unpaid revenue or revenue owings will be added to revenue received. Added to revenue received to get our revenue earned. And it is this revenue earned that the matching concept says will be matched against our expenses incurred to determine our profit or loss. And the second treatment, as we said earlier on, is that it will be added to current assets in the balance sheet or the statement of financial position. So these are how prepayments and accruals of expenses and revenues are treated in the final accounts of a sole proprietorship. This will be the end of this video, but if you haven't subscribed to this channel, I will entreat you to kindly subscribe and also share for the benefit of others. Until we meet again, it is bye for now.